Hello, my name is Brian Sapp and I love trading straddles. Why? Because moves like you see here happen frequently in the markets, and straddles are the easiest way to capitalize on these moves. I'm going to show you some of my favorite chart patterns so you can find and trade moves like I do. This is trading volatility with straddles. Now first we're going to discuss some basics of a straddle. What is a straddle? A straddle is the simultaneous purchase of a call and put option with the same strike price and same expiration. Now you profit with straddles by either seeing a significant move in price directionally over a period of time or by seeing a spike in implied volatility. Now when you buy straddles, you're essentially betting on an increase in this volatility or a price move. Now, by nature, volatility is what we call mean reverting. So a period that's highly volatile will typically be met by a lower volatility period afterwards and vice versa. So as a straddle buyer, what you are attempting to do is come in and buy the premium, the two options, at the point where you think volatility is going to expand. Now, a lot of times this can come ahead of market catalysts, whether it's an earnings report, a Fed release, things of that nature. These things can actually spark periods of volatility expansion. And you can buy these straddles ahead of those events, and oftentimes you can pay a discount for the options. Now, once you're in these positions, you can manage them however you like. Some people choose to leave them until expiration. Some people choose to leg in and out of positions as time goes on. It's very open-ended, and straddles are very flexible. You can build positions over time by initially buying a straddle. Now this graph right here is what the profit and loss profile generally looks like for a straddle. So if you look, it appears that they have bought the 40 strike because that is your maximum loss. The point of this right angle here is minus $400. So if the stock doesn't go anywhere and there's no spike in implied volatility, then your maximum loss will be at that 40 strike, assuming you bought the 40 call and the 40 put. Now you're going to break even on each side either with a $4 decrease or a $4 increase in price. So if you pay $4 for the straddle, the stock closes $4 higher or lower than your strike price at expiration, that's going to be your break-even point. And then beyond those break-even points, you have an unlimited upside potential. So that's the beauty of a straddle, is you have a defined risk, you have a defined outlay, but you have, in theory, unlimited profit potential. So we're going to get into a few of the patterns that I like to look at. This is my bread and butter pattern. This is what's called a symmetrical triangle. And what a symmetrical triangle is it's nothing more than a series of lower highs and higher lows, to where you see two trend lines, this 1, 2, 3 at the bottom and the 1, 2, 3 at the top. If you connect those two, you'll see it forms a triangle. And now what you're looking for is you are actually looking for some sort of indication that this triangle is going to break, and you want to buy the straddle, ahead of that triangle actually breaking. So if you look on this chart, you'll see this 5.8 is what I'm looking at. So you see this 5.8 right there, okay? Now what that is that's what's called the measured move. So from this point here to that point here, that is 5.8 units on the chart. So in theory, when this triangle breaks, that is the move that you're going to target. So the triangle breaks about right there, and eventually over time you get that 5.8 unit move to the upside. So that gives you a good guide as far as judging your risk and reward ahead of placing a straddle trade. So here's one example of a straddle playing out. This is Devon Energy, and if you'll notice, this is a series of lower highs and higher lows right here. So you get this trend line there, and you get this trend line here, and they eventually converge. And now you'll see the Bollinger Bands get really tight right there, and the volume is decreasing as time goes on. So typically, periods of volatility contraction are met with decreasing volume, and that's the case here. So when you start to see volume ticking higher here, that might be a sign that this triangle is about to break and this pattern is about to play out, and you're about to see some volatility expansion taking place. And this is the aftermath of how that pattern played out. And you see here, here's the triangle that we were just looking at, volume decreasing, and then you get upticks, and then you get this strong move to the upside. Now, the measured move on this was from about 68 to 58. So you're looking for about a 10-unit move on this triangle. Looks like it broke right here at about 64, 65, and then this move is ultimately about 10 units, up to 76 or so. So this is just a good example of that pattern playing out and how looking at charts can be very powerful in these sort of situations. Here's another example of a symmetrical triangle. This is a chart of Diamond Foods. And just like the other charts that we saw, you have a very volatile period here where you had a big move down on very heavy volume. And then you get this consolidation period where you're going to get volume that's decreasing. So volatility expansion in here, volatility contraction here, and you're seeing this series of lower highs and higher lows. You'll see these Bollinger Bands pinching, and we'll discuss those in a little bit. And these are all indications to me that something is about to happen. There's about to be a big move take place. And as you'll see, this pattern did play out very well. Here's your triangle that we were looking at. Volume decreasing. Then you see this spike here, volume starting to increase. The Bollinger Bands are very, very narrow here, and that shows extreme contraction in volatility, which is met with expansion in volatility. And just like these other patterns, the measured move, you're looking 16 to 12 and change here. So you're looking at about a $3.50 move to the upside. Well, this triangle actually broke at about 14, and then you eventually see this move up to 17.50 on the chart. So this is another example of where the symmetrical triangle played out very well. Another pattern that I like to look at is an ascending triangle. And what an ascending triangle is it's a series of higher lows into a resistance level. So you'll see here in the middle of April, you had a low, then you have a higher low in May, a higher low at the end of May, a higher low in June, and then you've got this resistance level that keeps rejecting the stock's price. Well, if you'll see here, this forms, kind of a triangle with a flat top, and volume is decreasing here, just like with the symmetrical triangle, and we're looking for some sort of catalyst to cause this to break. And very similarly to the symmetrical triangle too, this has a measured move concept along with it. So you're looking at about 24 to about 29, so you're looking for about a $5 move on the measured move breakout, and here you get a move from about 29 to 33. So while this one doesn't play out perfectly, it's a good guide for what you can watch for and what you can potentially profit on the upside here. Here's another example. This is Wynn Resorts, ticker WYNN. And you see here you've got this resistance area at about 95. And then you're seeing a series of higher lows into that resistance level. So you've got like a triangle forming here, higher low here, higher low here, higher low here. And you'll see the Bollinger Bands, they narrow very extremely right here. Now that's indicating to me, along with the decreasing volume, that something is about to happen. Now you see here volume starts to uptick. This is a sign that this pattern could and will eventually play out, and that more market participants are actually actively involved in the market and something could happen. And as you'll see, this is the ultimate result of this triangle pattern that we were just looking at. The Bollinger Bands are very narrow right here. Volume starts ticking higher, and then you get this eventual breakout of this previous resistance level. Now, from a measured move perspective, like we had talked about earlier, you're looking about 95 to the upside, about 70 to the downside. So you're looking for about a $25 move. Now, when this thing breaks at 95, $25, you're looking for a move to 120, and that actually did play out as you would have expected. So a straddle buyer right here, anywhere in here, for the most part, is going to do very well on this move, on this breakout higher. Another chart pattern that I like to target when trading straddles is the descending triangle. And this is actually the opposite of an ascending triangle. A descending triangle is formed by a series of lower highs into a support level. So here the support level is 44 or so, and you'll see a lower high here at 4 and a lower high here at 6. The volume, like these other patterns, the volume will decrease, which is showing volatility contraction. And then when you start to see an uptick in volume, that is a signal that you could see some volatility expansion. Now, in this case, the measured move concept also holds true. So you're looking at 52 or so, the highs on your highest highs, and 44 is the support level. So 52 minus 44 is 8. So when this pattern breaks right here, you're going to target a move down to about 36, $8 below the 44 price level. This is an example of a descending triangle. This is Herbalife, and you'll see here you've got a period of lower highs, and then this support level about 45 historically has been very significant. So you get a series of lower highs into the support level, and then you'll see here the Bollinger Bands get very narrow and volume actually decreases. Average volume over time goes way down from back here. You saw this period, this big down move, and then volume just kind of flatlines for a long period of time. Well, when you see volume starting to uptick in here, that could be a sign that something is about to happen and the stock's about to make a very big move. As expected, this 45 level eventually broke. You started to see some volume coming in here, and then you get this extreme volume move to the downside. Now, the Bollinger Bands, look how narrow they are there. That's another sign that something could happen. So had you bought a straddle in this area, you would have made a lot of money on this move downward in this big period of volatility expansion. Flags are also patterns that I like to look at for trading straddles. Basically, a flag is formed by a big move. In this case, is a bull flag. So a big move higher on heavy volume, and then you get a period of decreasing volume and consolidation. This consolidation period right in here is basically just the stock working off overbought conditions. Now, this is also volatility contraction, which eventually is met with volatility expansion. So you see the volume coming down, and then you see volume starting to perk up in here. That's a sign that something could be happening. It could be a sign that a move is about to occur on the other side. Now, the measured move concept also holds true with flags. So in this case, 28 to 38, when this flag breaks right here, you're eventually going to target about a $10 move to the upside here. This is an example of a bull flag here. This is crmsalesforce.com. And you'll notice this 160 level where the blue line is drawn has been significant resistance for some time on that chart. So this move here in mid-November on heavy volume is a breakout, and it rallies right up into that resistance level, and then you get this kind of flagging action lower on decreasing volume. So you get volatility expansion right here, and then you get volatility contraction down there. And then once you start to see some volume coming in, that's a sign that this could actually explode to the upside. And as you'll see, that's actually what took place. You had this period of contraction there, volume decreasing, and then you start to see some volume coming in there, and the stock blasts off and takes off through this resistance level. So a straddle buyer, you'd want to be somewhere in there buying premium after this expansion. You generally want to be a buyer of volatility during a period of contraction, anticipating the period of volatility expansion. Now, the opposite of a bull flag is a bear flag. It's basically just a bull flag flipped upside down. So in a bear flag, you get a big move down on heavy volume, and then you get some consolidation here on decreasing volume. Now, once this consolidation works off the oversold levels, it's a sign that there could be another period of volatility expansion about to take place. And when you start to see volume creeping higher like it is here, you eventually get this big move lower. So as a straddle buyer, you would like to target this period of volatility contraction in here in anticipation of the period of volatility expansion. Now, here's an example of a bear flag. This is Freeport-McMoRan, ticker FCX. And what you see here is you see a big move down on very heavy volume, and then you see some consolidation back towards the price it came from, some mean reversion, on decreasing volume. Now you also notice the Bollinger Bands here. These dotted lines are getting very narrow, and that's a sign that another big move could be ready to occur. So as you'll see, this is how the move played out. Volatility or volume, decreased during this consolidation period until finally we reached this resistance level at 36. The Bollinger Bands were very narrow, and then you start to see some uptick in volume here. And that's a sign that the volatility expansion could be ready to take place, which in fact it did, and you see this continued move lower. So as a straddle buyer, you would look to purchase somewhere in here, anticipating this next wave. Now, in addition to the important chart patterns that you're looking for when trading straddles, there are also some important sentiment indicators and volatility indicators that you like to look at that can increase your profitability. I like to look at increasing or very high short interest as a potential driver for entering a trade. Now, stocks that are highly shorted are typically more volatile than stocks that don't have a high short interest, and also stocks that have sharply increasing short interest can be more volatile than stocks that have decreasing or short interest that is flatlining. In addition to this, I like to look for increasing option volume and or near extreme sentiment in the options markets. I like to see a lot of calls trading versus a lot of puts. I like to see volumes much higher than what they have been. Those can be indications that something big is about to happen in that stock. In addition to this, I like to look for cheap options. And at Schaeffer's, we've created what's called the Schaeffer's Volatility Index. And what it does is it databases and categorizes all the option pricing, and we have historical data, and it will give you a number and compare that to the historical option prices. It will give you a good idea of what's cheap and what's expensive, and you want to buy these options when they're cheap because that's going to give you more profit potential on the upside. Also, I like to look at Bollinger Bands. A Bollinger Band at its core is just a 2 standard deviation line above and below the current price. So typically when 2 standard deviations are wide, that means that it's a period of high volatility, and when 2 standard deviations above and below are narrow, it's a period of very low volatility. Now, like we talked about earlier, volatility is mean reverting, so you want to buy straddles during the low volatility periods and then sell them after the volatility expansion. Now, I use all these indicators in conjunction with chart patterns to actually trade straddles. And as you'll see, these indicators actually work. I'm in charge of our Schaeffer's Volatility Trader service, and over the last 2 years, we've had some very good results trading these setups that I've just showed you. In 2012, our subscribers saw a portfolio return of 70%, and in 2011, our subscribers saw a portfolio return of 43% over that 12-month period. So these do work. The conjunction of technical analysis with sentiment analysis is a very powerful combination for buying straddles, and you can put them to work and make some money for yourself.